I literally got my approval while I was in Nigeria. And even for a while, my dad was like, are you sure you got an approval for a loan in Nigeria? He was really shocked. But it's a very easy process. You have to first of all kind of go online onto their website to see what schools they support. Because it supports specific schools. That's the disadvantage there, where it's like you're kind of limited to the schools that you can go to.
Yeah.
And they support more of the higher, so universities. They will hardly support colleges. Yeah. But yes, you just need to go on there, find your school there. You have a maximum of 100k USD that you can apply to for a period of how many years, whatever.
Yeah.
And then you also need to be in your, so if you're doing masters, you can get it for your entire master's program. If you're doing undergrad, you need to be in your third year. So after your first 2 years.
So there's you have to like self-sponsor the first 2 years.
Yeah, so it's kind of so you just need to plan it properly that it makes sense for your financial situation.
Welcome to this week's episode of Lobbyist Community Financial Wellness Podcast, your go-to podcast on all things community economic development, financial literacy, financial inclusion, and alternative banking methods to traditional banking and traditional finance. And so in today's episode, we're actually talking about debt management and budgeting. One of the things that came up a lot with the community when we asked in our previous episodes on what do you want us to talk about, what resources and what support do you need when it comes to financial wellness, one thing stood out was budgeting. And so I'm excited to be seated here today with Rimi, who's our guest and a personal finance content creator and an analytics professional by day. She has over 5 years of experience in the analytics space and is currently a senior business analyst in the gaming industry. She started sharing about personal finance when she realized that there was a gap in financial knowledge, especially for young adults. And her goal is to increase financial literacy among young people because no one is taught personal finance in school, and the earlier you hack it, the better. And she's always loved numbers from a young age, and she plays that into her professional work and her personal brand. Thanks for being here with me, Rimi.
Thank you for having me.
Amazing. So I know I just read a bit of a bio about you. I want to start from hearing from you. What got you into personal finance? What was that aha moment where you felt called to support other people through this? And what's your why?
For me, growing up, my parents were pretty good with talking to us about personal finance, like using like people's situations. So we knew a lot of tea, but really it was more like just like saying, okay, so this person did this, and then that's why you shouldn't do this, that type of thing. And so I just was always interested in it. And so like from while I was like, once I was 18, I started investing. I got mutual funds. Like even at that point in time, most of my friends were not. And so I started having conversations with friends like, oh, are you guys saving? Are you guys? And then everyone's like, saving, what am I saving for? Investing, whatever. I'm like, why? So I was kind of like that friend that kept on like asking, oh, did you save this month? Did you save last month? And then I was that friend like in all of my friendship group, and I was just like, I think a lot of people do not know about money. They don't know about personal finance. And then just because I've also heard a lot of tea, I know like you have to start early just because it catches up with you later on. So I was just like, I think I want to start a space where people or just be able to share more about personal finance. And I started with a blog first of all, but then my friend was like, in this day and age, how many people are going to be sitting down in video blog?
They don't read. We don't read.
Like, you need to do something with video. Like even when it's short form, even if you don't want to do YouTube, just do something with video. So that's why I started sharing on TikTok and Instagram. But yeah.
And I've watched quite a few of your videos. You really have a knack for breaking down and decoding and demystifying some of these huge concepts. Like even tax, one of the recent ones was around tax, right? So really making information accessible, and it comes down to inclusion at the end of the day, because the more you make information accessible to people who haven't been included in these conversations about finance, the more you're able to develop communities economically. Now you mentioned like being young and listening to our parents gist and gossip about this person is in debt and this person is this, and using that as a story as to why you shouldn't be that way and why maybe you should have that financial literacy piece early. What from your experience what's the landscape like for debt in Canada and debt in our community? What does that look like? Just setting the stage.
So I said definitely in the last few years debt's rate has been gone high. Like there's a lot more consumer debt, and just cause like there's increase in like cost of living, so debt has really been on the rise. I know I was reading some research where it's like almost like 60% of people that they did a study on, it's like they're scared about their finances. They have that constant like agitation about their finances, and about like maybe about more like 70% of that set, they also have some form of debt. Like literally, like everybody out of your 5 friends, if you ask them, do you have credit card debt? Most of them probably have like something there. So debt has really become that thing where it's like kind of part and parcel of people's lives, but it shouldn't be. And so that's something I'll say. And I'll say definitely for more like our community, there's that lack of knowledge which also plays into why they have debts. And so I know like when I kind of first of all came to Canada, I heard I kind of already researched just because I was really interested in personal finance. I knew about credit cards already coming in, but then something that was a common thing amongst like immigrants at that point in time was like, oh, I'm gonna get credit cards everywhere just because I have free money. So it's like all of them had like maybe 5 different credit cards, like the RBC, Scotia, BMO, and it's like they're just going to max everything out and then think it's free money. I'm just like, if you're trying to live in Canada,
like that was me though. Like that was because when you go to the banks, they don't even tell you, like they don't, because they make money off you, you know, using those credit cards and the ridiculous interest rates. And like you say, like in our communities, especially immigrants, depending on where you come from, like debt it's not a big thing. It's not in a way that it's done here. So when we come here, we have lack of understanding of like the implications of it. Like what is a credit score? Why should I be careful with my debt and etc. So you make a very good point there. But what are the different types of debts as well, right? Now that, you know, folks have come here, and if you're watching, like it's your first maybe month in Canada, what should you be looking out for? What are the different types of debts?
So I say there's different, specifically, it depends on the type. So there's different like high debt, like high interest rate debts versus low interest rate debts. But it's also depending on the type of debt. So for instance, credit cards, like if you have keep balances on your credit card, the interest rate is high, is closer to 22% across the board on credit cards, versus if it's like government. So that means if you're a citizen or whatnot, if you're getting like government student loans, that is cheaper. But like if you're also getting like international student loans, because I had international student loans, it was closer to like, it's probably closer to 15% right now. So it depends on the type of debt you're getting. And there's the auto one, like car ones, different ones. But like, and then there's the personal loan ones, there's the payday loan ones. Those ones are crazy high just because.
Yes, predatory.
Yeah. That's it. So I'll say it depends on the type of debt, and then that determines how high the interest rate is. But generally, we know like what's happening with inflation. Generally, even mortgage rates has also gone up to a certain amount. But I'll say that's how the different debts are categorized. I don't know if you want me to go more into that, but
no, I will. I know, but first you say something that I didn't know existed, and I think will be very valuable to our listeners, which is international student loans. Like what does that work? Like where do they go to find such loans? Because a lot of the challenges that international students face is like if you don't have a rich parents or you don't have a scholarship, like education is not as accessible. So how did you go about that? I think that would be a huge gem for them.
So I'll say for me, really, while I was deciding to come to Canada, because I came to school at Ivy Business School in Western University. So it's kind of one of the top business schools in Canada. And then when I told my dad, like, I'm coming here, he's like, how are you going to afford this? Because I'm the firstborn. And he's like, I guess I may have the money, but it's like, it's not only you. I have like 3 other children after you, and I need to take care of them. So I was like, okay, I'm going to do research. And then I did a whole like presentation to my parents, really. And I was like, this is how we're going to afford this.
Like insert businesswoman, like a business pitch.
Like my dad was like, what's it gonna do? But I literally did a whole pitch. I'm like, okay, so this is how much. I asked him like, how much can you afford? And this is how much I'm going to be able to get from student loans. And then I went to go and do research. So because I watch a lot of podcasts, I listen to Graham Stephan. Like I've always been listening to like the finance space for a long time. So I kind of knew there was international student loans, but I knew about them more for the US.
For the US,
versus Canada. And so I had to then do research on like what is available for immigrants or like international students in Canada. And so I came across Empower Financing and Prodigy Finance.
Okay.
Those two.
Can we spell those out for people, like where they can find them?
So Empower Financing is Empower, then Power Finance. I forget. I'll probably give you guys the link. But you can just Google it and you see like what Empower Financing is about. And there's Prodigy. So PRODIGY Finance, Prodigy Finance, those two. So those two, I don't know whether they're new ones now, but those are the two big ones that service Canada specifically. And how that works is a very easy process, because I literally got my approval while I was in Nigeria, and even for a while, my dad was like, "Are you sure you got an approval for a loan in Nigeria?" He was really shocked. But it's a very easy process. You have to first of all kind of go online onto their website to see what schools they support, because it supports specific schools. That's the disadvantage there, where it's like you're kind of limited to the schools that you can go to, and they support more of the higher, so universities. They will hardly support colleges. So they mostly support like higher institutions and then master's programs versus diplomas. So that's the checkup point there. But yes, you just need to go on there, find your school there, and apply. You have a maximum of 100k USD that you can apply to for a period of how many years, whatever. And then you also need to be in so if you're doing masters, you can get it for your entire master's program. If you're doing undergrad, you need to be in your third year, so after your first 2 years. So you have to like self-sponsor the first 2 years. So it's kind of so you just need to plan it properly that it makes sense for your financial situation. But applying is very, very easy, and then the rates are definitely closer to 15% now. So the rates are higher, obviously. Like, I know it's not going to be the same thing as if I was like a Canadian or a PR student. So you also need to put that into your planning and know that, okay, once you're done, you're going to have to pay this amount of rates. And so with me, what I did in that case was to also like kind of plan. I did like a forecast of like how much I would think I would earn once I graduated. And so I already kind of did a plan of how much I'll be paying monthly in order to pay off in 1 year. That is so smart.
And it also like forces you to pick on a program that's going to be high earning.
Exactly, that's going to high earning. And then also like plan. So because I wanted to finish paying it off in like 1 year, I was just like, how am I going to be able to achieve this? And so that proper plan is very important. Calculate the rates. It may be a little bit too much into the details, but it's just important to know if you want to get rid of it fast. And then another thing is also like, just because it's student loans, like you have a grace period of when you're done with your school, 6 months. So when you're done with your school, you have a 6 months grace before you start paying the principal.
I see.
Yeah.
Okay.
Yeah. But what I would always advise is to pay it off as soon as possible, because those rates are crazy.
Yeah, and so with inflation, you
have
can
to
be
pay
very
it off fast.
predatory.
If not, it's too much money.
That is interesting. Yeah, like I'm thinking specifically of a couple of friends already that are looking for such support. Like even some of my own sisters, because like I can't afford to pay for them to go to school. Our families cannot. So it's good to have this option, but also to be savvy about it, because you know there's like the 15% rate, which might even increase, and make sure that the job that you're getting into like offers you enough to live in Canada, because it is expensive to live in Canada, in addition to paying this loan off. But what is an alternative for international students to, you know, loans like this? Or if you don't have a scholarship, I think this is where a concept like AJOL comes in, right? Are you able to share how this could be beneficial for the international student community? I know in our previous episodes, Precious mentioned how her father, like back in Nigeria, used AJOL to like, he knew she was going to school in 12 months, so he joined a community of 12 contributors and was able to save up for that. But how do you think this could work for international students, but I also think for domestic students?
So I think it would definitely be very helpful, like especially even if it can come from the parents, like maybe your parents have already like done like an AJOL, because I know my mom used to do that too. But then it can also be from your own like point of view, like once you come into Canada, like maybe you already figured out your first term amount of money, but you're not sure how your second term school fees is going to come from. So in that case, what you do is to definitely like look for people that are similar to you, like look for people that you trust, and then pull funds together. So I think that would definitely help with not having to do too many like student loans, like just because like for instance, if I have like a 20k tuition that I'm not sure how I'm going to get that money from, rather than me taking 20k out in student loans, I can rather take maybe 10 or 5, because I'm going to try and get like the remaining 10 from AJOL. So I think it just helps with proper planning, and at the end of the day, reducing like how much you're going to pay if you're taking student loans in like interest rates or whatnot, and then just peace of mind. Like I feel like when you're with your saving money, that type of system with people you trust, you just have like that peace of mind, like everything's gonna be fine. So
I like that. I like that. And you touch on an important subject to me, which is how do we merge like traditional and modern, right? How do we merge, modern ways of banking? How do we merge CIBC with Agile, right? Like how do we merge Empower, financing with Agile? Because I think the two go hand in hand. But in terms of folks who are new to the country or folks who are just like underserved and underbanked, I think we're usually more vulnerable to certain lenders and to certain predatory lenders. What do those look like? How do we protect ourselves from that, especially as a community?
Yes. So I'll say definitely, especially when we don't have information, that's why like they take advantage of us. Because I know I've heard of people that had to take like personal loans. Personal loans are also pretty high in interest, like almost like 30% or some crazy amount. And so especially the reason why this happens is just because we're unable to get like the line of credit or the credit cards or whatever from like the big institution, and so we had to go to this platforms. And so they would always sell you the idea of like, yes, you're going to get the money now because you need it, but then the interest rates that you're going to battle with are crazy. Like personal loans and payday loans specifically are the ones that people are really falling into. And also the buy now, pay 4 times, pay right type of thing.
Pay right, after pay.
After pay, yes. That one, a lot of people, especially students that come in and maybe they can afford certain things or whatnot, they end up like, or maybe they need clothes or just things that they actually want to buy, they end up falling for, I'm just going to buy now, pay later. And the way they sell it to you is like, no interest. Because if you go, it's going to say no interest until you falter. and then
there's like $10, like Cecil. You just missed by a day, they give you like a $10 late fee.
And then you're just like, where did this come? And it adds up. Like even if you're not noticing it at that moment, it adds up to something. So I'll say those 3 major ones are the ones that people definitely fall for. And always, I won't even say fall for, also like just out of need and just because they don't have access to the more lower interest options, they have to take this.
So they sell you convenience, right? They sell you convenience. Like it's going to be here right now, like it's 5 minutes application.
And it's always super fast, like the application.
Because they know they're getting you like before any sense comes to your mind, they're gonna get you quickly. But it's so funny how different it is with back home, because back home we do have a similar, at least in Zambia, we do have a similar to like buy now, pay later. We call it lay-by, except you don't get what you've purchased until you're done paying. So you actually have to make the complete payment before you get that good or service. So you're able to think it through, because you're not going to get it anyway, and there's not that convenience factor. And it's the opposite here, because again, prey on a bit of desperation, like we're new to the country trying to navigate the systems, and I think there's lots of room for the community to come in and to offer this support, especially when people have emergencies to people, so that they're not falling into this trap, because then it becomes now a cycle of you spend the next 7 years paying it off, whether it's through collections, whether it's through like a ridiculous credit score that then increases your interest rates in other debts that you want to get, or even like consumer proposals. A huge part of it though, I think, is also just learning, like you said, with students, like learning to live below our means. And I know sometimes it can be very challenging, especially in a very flashy culture, a very flashy society. But a huge part of that comes from budgeting. So I want to touch on that. What are some essentials that people should keep in mind in budgeting? Because budgeting, in my opinion, is proactive to avoid debt, right? So instead of constantly reacting to, okay, now I'm in debt, now I gotta get a consumer proposal, now I gotta fight these collections, like how do we prevent it from the very beginning?
Yes. So that's something I always feel like budgeting. And budgeting doesn't have to be restrictive and strict. Like I feel like that's kind of the fear that people have with budgeting. Just like, I'm not going to enjoy myself. I'm just going to be living. And that's not what it is. Like budgeting just helps you like ensure that you're sticking to things, like, and ensures that you're actually like hitting your saving goals. So for instance, like if you look at your budget, before making a budget, actually, first of all, you need to understand what your fixed expenses are. So, and so before you make a budget, what I always say is, first of all, track your expenses for like first 2 months, just because you need to understand the averages. So know how much you're spending, because then that helps you then create the most optimal budget for yourself. And so be creating your budget, know what your fixed expenses are, and then your variable expenses. And then if your variable, and then look at your income. If your expenses more than your income, something is wrong, because we don't want that. So I think from there, you now need to then like cut down on things. So you can start from your variable expenses. And when I talk to people about budgeting, I always say prioritize spending on things you enjoy versus things you don't enjoy. Because sometimes when you sit down and look at some of your purchases, like maybe you bought one dress for $200, and it's just like, was it really worth it? Like, and so it's like sitting down and thinking through like, okay, these are the things that actually make sense. Like, I'm excited to spend on this because it's fine for me, versus like, I'm not excited to spend on this. And then I know I did that exercise recently, and what I realized was that I was spending a lot on like Uber Eats, and then it was like at some point I sat down, I was like, I actually, a lot of the times after I buy it, I'm just like, I did not enjoy this food.
This food at the end of the day. I feel so attacked because like that's always me. Yeah. I'm like, I spent like $50 on Uber Eats. It's like, if I use this at No Frills, I would have gotten a nice piece of steak for $15. And I would have enjoyed it.
You have enjoyed it more because like it just maybe doesn't taste good. I'm just like, why am I spending this money? And so for me, in that case, I would then like prioritize like meal prepping, now shopping, looking for things that will help me like buy the things I want to, or cook the things I want to eat. So I think understanding that thing of like, okay, what brings me happiness, or what are the expenses? And there are some people that enjoy eating out, and that's fine. So allocate more of your budget to that. That's fine. But then remove the things that don't serve you. So maybe you don't like taking even Uber, you rather take the TTC. Remove those things that don't serve you. That's fine. But then there's also the place of then checking your fixed expenses, because people also forget that. Like, it's fine to live with a roommate. I understand. It's not like comfortable, but like you also need to understand seasons in your life. Like, when I was paying off debts, I was very strict, and I told my friends, all of them knew I was paying off my debts. And so nobody should be inviting me out to things I don't want to go to. I'm not outside. So like things like that, also letting them know about like what your goals are also makes a difference, so that it doesn't seem like you're rejecting stuff. So for instance, like if someone invited me, I'm like, I can't afford this right now. That doesn't mean I'm not going to be able to afford it another time. So I think that communication piece also helps you with even like tracking whatever goals you're trying to achieve. Maybe it's a saving goal, or you want to pay off debt, whatever it is, and then looking at that. But then also my point with that fixed expenses part is, if it's fine to downgrade your living situation. You don't have to live in that condo that's top price right now. You can downgrade it. You can also look for like things like with your mobile plan, like look for cheaper options. I know like the big banks not the big ones, the big communications is on the higher side, but there's the lower ones that you can actually find. So I think also checking your fixed expenses to see what makes sense to remove or reduce will also at the end of the day help you with then reducing all of your expenses, and then having room for whether it's debts, savings, or whatnot. In that case,
you make like so many good points, and one of them is around communicating with the community, because I feel like, I don't know if it's by nature of the generation that we are in, like we don't do a lot of openness and like that vulnerability when it comes even to finance. Like, guys, like I'm really going through it. I can't go out today, or like even more social economics, which we do back home. Like our mothers will come in a group, they all go buy a got together, and then like they cut it out. And there's ways to do that even as you're budgeting here, as you're saving, like, you know, pull funds together, go to Costco, buy things in bulk, and like, you know, spread the costs. I think there's lots of value in that. I think another piece as well is in line with community accountability. I think there's strength in numbers. And so if you have people who are keeping you accountable to some of those financial goals, I think you are more likely to achieve them. Similar to if you have a gym buddy, you're more likely to go to the gym. And I think that's where yet another value of systems like Agile come in, because they force you to actually save. Like if you have a group of 10 people and every month you're putting in $100 and you know like someone's payout depends on you putting it in, even if you have other things that you would have prioritized, like if you have Uber Eats that you would have prioritized, like now you're accountable to keep that $100 to contribute, because you know people are depending on it. I think that's an important one as well. And then for those who, you know, for whatever reason, we've made terrible decisions and we haven't been budgeting as well, and we found ourselves in a lot of debt, whether it's student loans, whether it's like personal debt, which is usually the highest interest one. How do people approach that in terms of now managing the debts? Because again, there's still predatorial practices even at that point, even when you think of like consolidation, which sounds like a good idea sometimes, but then you think of the fees that you're paying to these trustees, right?
Yeah.
There's that to take into account. So how do people go about that? In particular, like if you can talk of debt snowballing or the debt avalanche, for those that don't have context on it.
Yeah. So I'll say there's different ways to pay your debts. First of all, like before you even start paying, like if it's a credit card that's costing to have them, cut it up and throw it away. Thank you. Whatever it is, like if you can definitely like remove it from your situation, is very important. Like if you maybe on your shopping sites, there's constantly pay. I don't know how that's possible, but maybe you constantly pay by, like if there's a way to turn off like that automation type of thing where you don't see it, is very important. And then when it comes to paying off debt, there's different ways. So there's a snowball, there's the avalanche. So snowball method is when you start or you prioritize paying off the smaller debt amount. So for instance, maybe you have 3 different debts, like maybe a 1,000 credit card, 3K credit card, 4K auto loan or something like that. You're going to prioritize the 1K one because it's a smaller amount. And the reason why this is a good option for most people is just because of the emotional and the mental thing that it gives you. Like it just gives you that boost where you're able to pay it off faster versus you paying off the 4K one, and so you have that more motivation to keep going at it.
More momentum.
Yeah, more momentum, exactly. So that's why the snowball method is there. But with the snowball method though, there's something is that you're probably going to have to pay more in interest rates just because you're pushing your higher interest debts further. Yes.
Okay.
So I think the way I'll come at it, we're trying to, let me explain the avalanche before I come out deciding which one to use for you. And then the avalanche on the other way, that one works with prioritizing your highest interest debts. So for instance, maybe you have, as I mentioned, you have multiple loans or debts that you have, and then the one that has, maybe there's one that's like 15% and there's one that's 4%, there's one that's 1%. You're going to prioritize paying off that one that's 15% off first. And the reason you're doing this is because at the end of, in the long run, you're going to pay less in interest versus the other method.
So I've been lying to people because I've been saying the debt snowball, the avalanche as the snowball, where you start with the highest interest, but that's not the...
Yeah, that's not it.
Okay.
Yeah. So the snowball focuses on the smallest amount. The avalanche focuses on the highest interest rates. Yeah. And then when I say prioritize, that don't mean you're going to stop paying on the other ones you have. You're still going to pay the minimum on the other ones, but then you're not putting more money to pay off that one first.
Yeah.
Like fast. And so with the avalanche, like at the end of the day, you're going to pay less interest rates because interest rates compounds the more. So if you're able to pay faster, you pay less interest rates. So that one is good. So in terms of deciding what works for you, in terms of the method you want to use, I find that people tend to do snowball more just because like they like that momentum and motivation. Because it's not easy making money and then giving it back to something. I understand like you may have used it for something important, but it's not just easy to do that. So that snowball method helps with just like having that momentum to keep going at it. But for me, I'm going to use the avalanche anytime because I'm trying to save money every single time. But yeah,
because it's also an emotional game. Money, it's definitely an emotional game. So for those who are like emotionally attached, maybe the snowball works better because it gives you a little bit of motivation and satisfaction. But for those who are logical, and also especially if you have like extremely high interest, then maybe you want to go for the latter. But let's talk life after debt, or even maybe life during debt, which is credit building, credit repairing. How can individuals who've struggled with debt begin to repair their credit scores and ensure a healthy financial future? What are some ways? I've seen coho and like different ways that are untraditional, that don't get you into further debt. So what would that look like?
So I'll say first of all, like you have to make up your mind that you want to like kind of get into that better position, because like I have a friend that was also like in the low or high 500s and now she's closer to 800 now, just within a year.
How long did it take her? Just
like almost like motivated. A year, just kind of a year.
Yeah.
So it wasn't a bad time. And so what you need to do is to first of all kind of pay off that first, like pay off the debt first of all. Like so look for whatever the methods that we mentioned, whatever method works for you to start paying that off. Then once you start paying that off, then you have to now have like good like systems in place to ensure that you're using your credit properly. So if you're using your credit card, ensure you're paying it before the due date. Ensure that you don't keep a balance, because you keeping a balance is kind of what is recorded from to the bureau, to the credit bureau. So ensure that you're using it properly, and then you're still using it, because that's another thing, because people run away from credit cards, like, especially when they've been scarred from it. And at the end of the day, like, I won't fault some people if it's fine. Like, at the end of the day, it also depends on your person, what works for you. It's fine if you completely remove it from your system, but I would say learning how to use it is just a better option. Like, just learn how to use, because that gives you more control over money.
Exactly.
Yeah. So I'll say using kind of those, like, so start paying regularly. Don't keep a balance. And then you can use things like Coho. I know there's Coho. There's another one, Check C. But ensure that you're looking at the terms properly, and then you're not selling, like, doing something worse up to your credit card. So, like, use things like those rent repayments type of thing. I know Check C does that. If you pay your rent, it also adds to your credit record. So use things like that to also help build it up. But it's fine if you don't even use Coho, because my friend didn't use Coho. She was just doing the normal, like, paying off a credit card before the due date, paying it before the statement dates, and then using it regularly, just because she needs to show that she's using the credit card. And then it just started going up gradually
from there.
Yeah.
And then for Fox, there's actually a specific episode that has been aired already about all things credit score, like what constitutes a good credit score, what are the different utilization percentages that you should keep, for example. So check that out with Adiba. But what you mentioned around, like, not cutting up your credit card completely, a huge part of that is because of credit history.
Yes.
Right? Like, the longer you've had that, the better. But then there's also folks who are especially new to the country, or just kind of reviving their credit and want to rebuild that history. I think one of the other ways that can be done through Wovio's digitization of AJOs is so that when you contribute to the AJO, the rotating savings circle, that's being reported to the bureau as a positive payment. I think that's very important for people, because it's doing about 4 things for you in that, right? One, you're building that credit in that, we're reporting to the bureau as positive payment. 2, it's fostering a sense of financial discipline, because you're accountable to a community and you have to save. And then 3, you're actually saving your own money that you can access at any time, and that creates like an emergency net. And on top of that, you're helping other community members, because you're pulling funds and we're able to achieve different financial goals. But then wrapping it up with the emergency net, because that's a huge part, and I think that's mostly why people do get in debt, quite honestly. I think it's less that it's lifestyle creep and more that, life just happens and emergencies happen. And if you don't have different support systems, you resort to these debts. So how do people build these emergency savings and net? And also, why is it important? Why is it important to have this?
So I'll say, first of all, like, on the importance of emergency funds. So emergency funds are very, very important, because life happens. Like, you don't know when something's going to come up. Like, your car may just up and stop working, or you need to repair something, or you may have to move, or just something comes up, or you may have a medical condition or medical thing that you may not have access to insurance at that point in time. So, and then a lot of times people think, nothing's going to happen. At the end of the day, you don't know what's going to happen until it happens. So emergency funds are very, very important. And what I always recommend is to kind of keep 6 months to 12 months of your living expenses.
It's a lot of money.
It is, I know. But then it's just important to have that peace of mind. I just know that I have something to fall back on if anything happens. And then it's a lot of money to keep in cash. Also, because for me, like, I invest a lot, so it's like sometimes I'm looking at the money like, this money I could put it somewhere else. But it's very, very important, just because things will come up. I know I recently had to move, like, abruptly, and I had to take a huge chunk of money from my emergency fund to kind of support my movement. So it's very important to have that. And so with saving for that, like, you just need to kind of put that into your budget. So start saving for it, like maybe $100 weekly, bi-weekly, whatever works for you. Like, look at your situation and what works for you. But I'll say, first of all, calculate how much that 6 months to 12 months is for you. So looking at your fixed expenses specifically, and maybe a little bit of your variable expenses, and then put that number together, multiply by 6 or 12 months, and then save that amount of money. And another thing I'll say with your emergency fund is ensure you're keeping, say, high interest savings accounts, because you still want to get some money on top of that. Like, you don't also keep, because inflation is happening. Even though I'm not saying your high interest savings is going to save you from inflation, it just reduces the effects of it, because inflation is pretty high either ways. But then, for instance, like, it makes sense for you to have if you have 1,000 now versus like maybe 1,400 by just keeping it in a high interest savings account. So I always recommend to put it there. I don't know if you want me to mention. No,
I was gonna ask.
Okay.
I was gonna ask, like, what are some high interest savings accounts that people can look at? What banks would you recommend for that?
Yeah. So I'll say definitely more like the digital banks, because unfortunately the big banks do not really give you the best rates.
Yeah.
And that's because at the end of the day, they're making more money from other sources. They don't really need that. And so the digital banks will give you more of that. So I know like there's Tangerine Bank. There's EQ Bank also.
I don't know why I was gonna say EY. It was in my mind.
EQ Bank also gives 4% if you do some things. And there's Neobank also. Neobank is 4% on its own, like no promotion. So that one's actually kind of the top one right now, one of the top ones.
Interesting.
There's Motive Financial. That one is also another bank. The UI UX for that one is more like a big bank, but it's a digital bank. So, but it's 4.1. So that one's pretty high. And there's World Simple Cash. So World Simple Cash also gives you 4%. So I think the average right now is definitely around 4%, but definitely looking for those banks and keeping your money in there is important.
Amazing. Thank you so much. I could I need to pick your brain for so many other things, but where can people find you first to pick your brain? Because I know where to find you, but where can they find you?
You can find. Yeah, so I'll say I post on TikTok and Instagram. So TikTok, Wealth Savvy Gen Z on TikTok. What Savvy Gen Z, there's nothing in between or before, because I have a bunch of scammers now.
Yeah.
So please follow the right one.
I feel like that's the assessment of success these days. Like, do you have any scammers? Do you have any fake accounts?
But it's so annoying, like, because people are messaging me every day, like, oh, somebody sent me message. I'm not going to send you anything. I'm not sending you anything.
Yeah.
Please. So there's nothing before, after. It's just What Savvy Gen Z. And then on Instagram, it's Rimike Lala at Rimike Lala. I also have a blog that's whatsavvygenz.com. So I'm reviving it soon. But yeah, that's where you can find me.
And we'll be sure to link those as well. And then just for like the last piece, what are 2 or 3 key takeaways that you want our guests to leave with today?
Yes, I'll say 2 or 3 takeaways. I think definitely understanding and knowing about money, like financial literacy, is very key. Like I know lots of people tend to overlook it, but it just sets the stone for a lot of things in life, because at the end of the day, money is an enabler, and so you're going to need money. So not knowing about money is a worse off situation. So I'll say definitely improving financial literacy.
And I'll add on, like, you should subscribe to our podcast to improve your financial literacy.
Yes, definitely subscribe to Bobia. And I was going to touch on the fact that I really like that they also help with reporting to the credit bureau, because that just makes it perfect, because now you're doing a lot, as you mentioned, just using Wovio. So definitely subscribe to apps like this, like use YouTube to learn about it, use blogs. There's so many like information out there. You just need to look for it. Another thing I'll say is definitely take control of your finances. Like, don't just leave it to a portfolio manager. Like, it's nice, like, you can, obviously there comes a stage where you will need them, because you have things. That's the goal. Wealth, guys. The goal is wealth. But then definitely be in control, know what's happening. Don't be a novice to your money. It's not good at all. And then I think another thing is just learn how to save and how to budget. Like, build that discipline, because from saving leads to then how you have money to invest, to then knowing how to pay debts. Like that's kind of like the building block to then everything, and like your money then flows through all the different platforms, buying houses or wealth or whatever. But learn how to save and live below your means, because everything is flashy. You don't need to buy what is flashy, because in retirement is when you kind of see how people have spent their money. And then even some people, I know I was talking to, I can't remember, but I know I'm going on a tangent now.
Go
but then
on.
we like even like people that sometimes you see them, they're doing, like, they have big positions and whatnot. Like, a lot of them don't have nothing to their name, and so it's not just about like you having like, oh, you have a position now right now, but like you also need to plan for your future and you start planning for it early. If not, it catches up with you. And then most of them, they probably just have a house, and it's like that's why a lot of them don't retire early, because like they don't have nothing to fall back on. So definitely avoiding putting yourself in that situation by starting to plan for your retirement early. And it makes a big difference.
And we won't always be strong enough and healthy enough to work, and sometimes we're forced into retirement. So just thinking of those pieces and like having, I would add to everything that you've said, is also like having a great emotional attachment with money, healthy emotional attachment with money, because it is an emotional game, and sometimes we're scared of it. That's why we like cut up our credit cards, and then we still find ourselves like borrowing anyway. So like working on that money trauma and that money emotional wellness is very important. I think we should have a podcast on that actually. Now that I think of it, we'll have you back for that one. But Rimi, thank you so much for joining us today, and thanks for all the gems that you shared. I imagine like a lot of people are going to be reaching out to you with questions, so we look forward to having you again. But thank you for educating us.
Thank you so much. I really enjoyed this. I enjoy talking about money, so it's always very fun. But thank you so much. Really enjoy
talking about money and enjoy spending it. I appreciate you. Thank you, Rimi.
Thank you so much. Bye guys.